What is up, everybody? Okay, now I got to figure out how I get this banner off of the screen. Let's go.
Yes. Here we
I
go.
figured out, guys, why you couldn't see each other because I had a banner covering up you. So now we know.
Good to see everybody.
Hey, welcome to this live show. We can see your comments. So give us a thumbs up. Let us know. We see you, Dion. What's happening? And anyone else, if you're coming in from YouTube or X, give us a comment, show us some love. Hey, what's up, everybody? Welcome in. My name is Ellis Hammond. I am the Vice President of Capital at Aspen Funds. And sorry, we're trying to figure out audio stuff here. So I'm the Vice President of Capital here at Aspen Funds. And I do these shows for two primary reasons. One, our goal at Aspen is to become $1 billion investment firm over the next 5 years. And I really just want to track that journey and share what we're doing behind the scenes with other capital raisers and fund managers. One, because I like doing it. It's really fun. We can look back on, all the things we tried and did that didn't work or did work and get to share along the way. And secondly, we work with other fund managers and capital raisers to really, and that's part of our goal, to really get to $1 billion firm, is to partner with other expert capital raisers, expert fund managers to reach that $1 billion goal. And so if you're interested in working or partnering with us, you could raise at least $1 million of capital. Go to aspenfunds.us/fund manager. So I'm pumped to be joined by two amazing guys, authors, entrepreneurs, business owners. If you don't know who these guys are, where you been? So co-host, and hopefully the guy who's going to show up here regular with me, is Mr. Walker Diebel, author of Buy, Then Build, and an incredible entrepreneur, business owner, and capital raiser. What's up, Walker?
Ellis, super pumped to be here. Thanks for running this series. Looking forward to it.
And we are joined by great friend, another incredible entrepreneur and capital raiser, Mr. Hunter Thompson. What's happening, man?
Honored to be on, man. Excited for the conversation.
Really excited to have you here. Hunter and I have known each other for a long time. I remember even before I got into the world of raising capital, I somehow landed a 30-minute meeting on Hunter's calendar, and he was gracious enough to take it, and he's taught me a lot along the way. So I'm really excited to have you, Hunter, as one of our first guests of this live show.
Same. It's mutual. It's been awesome to watch your career as well, and I'm super excited about this journey with Aspen Funds. I got a lot of respect for you guys, so excited to see where it goes.
Yeah. Hey, so for folks who don't know who Hunter is, ASIM, talk about just the two big things you're working on.
So I have two companies. One is raisingcapital.com, which is a something that teaches capital raisers how to raise money. And you can just go to raisingcapital.com and check it out. And ASIM Capital is my private equity company where we actually implement kind of what we talk about. So we are a multifamily owner operator in Phoenix. We have about a 40-mile radius that we buy in, and that's really all we focus on. But that has been that's been something that we pivoted to focus on in 2022. Before that, it sounds like you've got a lot of listeners that are capital raisers. I'll be honest, and sometimes I make these claims and it makes me cringe a little bit, but every now and then somebody will back me up and make me feel, okay, I'm not just completely insane. But I'll put it this way. And this will for sure sound kind of like self-focused or whatever, but maybe we can help provide some context. So the term capital raiser is a relatively recent term in the world of real estate in particular. And I think I played a role in the popularization of that term. Not to mean that I invented it, but I think I played a role in it. And I think part of that is because I certainly played a role in the popularization of the fund of funds vehicle in the real estate sector. This is not because I'm super intelligent or anything like that. I just kind of stumbled into it. It was the first way I ever raised money. I didn't even know it was called a fund of funds. I just thought it was a good idea that if I could go out and find someone that really knew what they were doing, rather than try to compete with them, I could pull together 10 people in a special purpose vehicle and then invest in their deal. And so that's the first deals I ever did. started, I was investing in 2011 and 2012, really started to scale that kind of company starting in 2014 or so, and raised around $50 million as a fund of funds manager, and then pivoted the business. I was under a broker dealer for some time, and then later decided to go all in on being a GP and buying deals directly just in Phoenix. And that's basically because of what happened with interest rates. So we'll talk about all the story of all that. But the point I'm saying is, because of my background as a capital raiser, I have been able to work with a very diversified look at geographic locations, risk profiles, investment strategies, owner operators, asset classes. Like, I've raised capital for and been intimately involved in mobile home park transactions, office, industrial, retail, non-performing notes, performing notes, you name it. I've kind of been involved in it. And it's led me to have a pretty interesting career. Now, some of you listening to this might be like, yeah, that's exactly kind of stuff I want to do too. Well, if you do that for 10 years, you will know a ton about real estate because you'll be able to work with a ton of groups. Before the popularization of the term capital raiser, most people would just find one asset class and go all in. And that led them to be able to go very deep on one particular topic, but they only probably worked with one attorney, one geographic location, one asset class. And so you have a very different view. So I'm excited to kind of share everything I learned along the way and why we made the pivot and what I think about the market and what I think about owning a business in 2025.
Yes. So we're all about to meet up in a couple weeks. Can we talk about that real quick and then get into it for anyone who wants to join us?
Yeah, I appreciate the opportunity. So right now, I have seen something that I'm very disappointed in, which is that everybody for 10 years was hoping for a market correction. And what happened is that in 2020, we saw a hesitation in the market. We thought, holy crap, there's about to be a massive downturn. It's illegal to work for some, like a huge percentage of the population. Certainly there's going to be a downturn. And when that market hesitated, everyone said, oh, but not like this. This doesn't count. This is insane. There's a massive government lockdowns. There's massive pandemic concerns. There's that kind of thing. And I was like, hey guys, like, if you want there to be a correction, especially a significant one, it's always something you don't want. And it always feels like it's a random black swan event. Now, it ended up being the case that we didn't have a massive correction in 2020 because of money printing and other things. But then 2 years later, interest rates rose faster than they've risen in 40 years. And it's now created significant distress, especially in the most prime markets in the United States, in the most prime asset classes, specifically multifamily. And so what ends up happening now is that you see that correction and people go, not like this. Like, they were praying for a recession. They were praying for a correction. But when it comes, then you actually realize what that means, which is that it's a freaking horror show. And that, my friends, is what creates the opportunity. So when I am saying I'm disappointed, it's like, are you cut out for this industry or not? And if you are, now is the time. You do not want to retreat. You want to go all in when other people are retreating. You want to stretch yourself to emotionally, financially, whatever it takes to capitalize on these moments. Because if you miss this part of the cycle, it's like the whole fun part of buying right is happening now for the next 24 months. And then it will be very, very different for the deals you buy in 2027, 2028. So if you want to learn how to do the one thing it takes to actually close deals, which is raise money, then you should come check out this event we're having in Phoenix called Raise Fest, which is the only conference specifically focused on raising capital. And it's going to be awesome. I'll be there. Pace Morby will be there. Cody Sperber will be there. Ken McElroy will be there. And a bunch of other $10 million, $50 million, $100 million capital raisers, some of which you've heard of and maybe some that you haven't. You can check it out at raisefest.com. It's going to be awesome.
I'm going to take raisefest.com in the comments. I'll be there.
Let's go.
Walker will be there.
I'll be there. Hunter,
Aspen will be there.
I got a question. So let me jump. Like, Hunter, basically what you just said, like what I heard is, first of all, I agree, right? I think that, what you're talking about is getting into a business when everyone else is kind of walking away over and over and over again. That's how I found success myself over the last 20 years. And one of the things I heard is you were just talking to people that maybe have never raised capital before. and you're sort of introducing this concept of like, come learn what it takes to be a capital raiser. Would you mind, like, two things? One, would you mind like just kind of talking very briefly about the business model of becoming a capital raiser, what that means, what, you know, the life that someone can build for themselves? And then maybe also, if you don't mind, maybe clip on just a couple of the misconceptions that a lot of newbies kind of come in thinking like, hey, this is what's going to happen, but like it doesn't.
Well, I mean, there's many, but the one thing I'll say is that I grew up with a little bit of a, you know, I didn't really excel at school. And I think part of that is because I kind of felt like I was the path of least resistance kind of person. Like if I remember in college, for example, I got a C on a macroeconomics final. And I remember literally standing up and being like, I am the smartest man alive. Like I literally did the minimum amount of work to get this C. I didn't do one extra hour that I didn't have to do. And I also didn't fail the grade. So that though put a little bit of a mental ceiling on terms of like my future, to be honest. And even though I thought it didn't for a long time, I later figured out that I think it did have an impact on me.
Mhm.
However, now that I've shed that ridiculousness that school is an indicator of how much money you can make and how successful you can be and how much influence you can have, I realize that really what it is that I am really focused on efficiency. And to me, school just wasn't a very efficient modality. So I didn't put myself into it. And since then, no one has seen that I got a C on that final, right? So I was correct in the sense
Until
that
now.
that really wasn't material until I shared
Until
it just
now, when
now.
you just shared it.
Totally. So the reason I say that is that when I look at the world of business, I'm trying to find hyper high leverage activities or hyper scalable activities. And if you look in the world of business, you find really pronounced examples of this in things like media and things like anything that's one-to-many versus one-to-one, in things like capital. And so I'll give you an example. If in the real estate sector, if I'm looking at it broadly, if I'm listening to this, I'm like, I want to get into the world of real estate. Okay, you can go and learn how to underwrite deals. You can go and learn how to find good markets, but the skill isn't desirable infinitely. Like if you go to a conference, let's say, about how to underwrite deals, and you are really freaking good at that, and you're sitting next to someone that is learning how to do that, there's no real opportunity for partnership there because the skill isn't something that's infinitely needed. Money, capital is infinitely needed. So when I looked at the space, I was like, what's the way that I can get a seat at any table? It's not knowing what a cap rate is. It's not being the best Excel modeler. It's not even having a personal connection with a broker. It's money. Because if I can bring money to the table, I can get a lunch with anybody. And from my perspective, in the intro, you mentioned if you can raise $500,000, let's talk, or $1 million, let's talk. That to me is going to get you a seat at the table. And what does that mean? If you can find 10 to 20 people that will invest 50 to 100K with you, you all of a sudden can skip the line of wholesaling houses, fix and flipping properties, doing $20,000 rentals that will probably not make any money, but look really good on paper, which is the typical route of most real estate entrepreneurs. So my goal was to skip all of that and to play immediately at the biggest level in the non-institutional space, which is, you know, typically buying $20 million to $50 million properties. And my path was to find someone that was really good at that and just basically say, hey, if I show up on your doorstep with $500,000, will you give my entity, my SPV, my special purpose vehicle, better economics than a typical investor? So a lot of y'all are familiar with waterfall structures. Without getting into too much detail, let's say a typical investor was going to get a 70-30 split. I go to this operator, I say, if I can bring $500,000 to your foot, will you give me an 80-20 split versus a 70-30 split? And they said yes. And so my business model at the time was I'm going to go find 10 people to go invest 50K and invest in my SPV and then invest in their deal and basically keep the delta, the difference that I negotiated with them. The problem though, is that it's way harder than most people think. And even though the deal I had was great, people, they did know, like, and trust me, by the way, that I pitched to, they weren't excited about the investment. They weren't knowledgeable about the investment. They didn't have confidence in their ability to analyze the investment. There was no urgency or scarcity or fear of missing out. And so the business that I created started with making this massive mistake of thinking that because a deal is good, the money just comes to you. And so for people that are interested in getting this space, most of you will probably fail miserably on your first capital raise. And then you're going to have to make a decision whether you're going to go ahead and just go on the normal path and be a dentist, or you can focus on what we're going to talk about today: finding leads, generating interest, attracting people, curating them, and then, creating that urgency, creating that fear of missing out, and getting them the opportunity to invest. As far as answering your question directly, it is an incredible lifestyle business to build because of how infinitely scalable the skill is. Once you do what I just talked about and what we'll probably talk about in this interview, the difference in your work to raise $1 million versus 10 million is nothing near 10x. In fact, it's very close sometimes to a 1-to-1 ratio. When I can find skills like that, which they're not many, but there's some, and modalities like that, that is what we call a scalable or high leverage activity. And that's why I decided to go all in on the capital raising side of the business and ended up raising $100 million as a high school slacker.
And who can do this, Hunter? I mean, you had to overcome, skepticism, build credibility, all these things. And I think it's one of these where, if people kind of enter into this with, a really strong resume, it's obviously going to be very simple. Right. I mean, are there sort of like, I don't know, hacks, that people can use to sort of like overcome that kind of like, what are you doing now? Kind of response.
Listen, man. So I mentioned before, raisingcapital.com, right? That's where we teach people how to raise money. So, and we've had hundreds of clients. I did the numbers in the 600s or 700s of people that have invested significantly to build a business like what I'm talking about. Yep. And so because of the number, I've seen a massive spectrum out there of people that come through our program. And so sometimes we'll get someone that's like, what's up, man? I just went through an IPO, sold my company. Most of my friends were invested in the company. And now I'm kind of in a mastermind of people that just have gone through IPOs. And it's like, okay, send out this text message, do this webinar. You're going to be able to have success really easily. And it's like, I know this guy's going to crush it. Like all he's got to do is just follow this playbook. And if he brings the level of intensity he's already accustomed to bringing, that he had to bring to his company to IPO it and get around that network, he's going to have success. But there's also people that come in and are like, what's up? Now that I invested in this program, I have no money. And I'm like, oh, all right. Well, who's your network? Well, I worked my whole life in nonprofit and just trying to help people get money out of the stock market. It's like, okay, that's a very different starting point. But I'll tell you, man, I happen to know one of the guys that worked in nonprofit on this show right now. Some of those people freaking figure it out, and it's because they don't freaking quit. And I'm in the middle of a capital raise right now, and there's such a big difference between the mentality of the people that just don't quit and the people that just quit. And like, when we're working with new capital raisers, which at ASIM Capital, we have a similar model, a lot of the money we raise comes from fund of funds managers. We want to give people their first shot. We know it's going to take hand-holding, but some people won't even let us hold their hands. I mean, if you send me an email right now from anyone listening to this, send me an email that says, hey, Hunter, I'll give you $1,000 for an hour of consulting. You're not going to get a response because that doesn't get my attention. But I will help you raise capital for our deal. But some people, for free, by the way, but people are not used to getting their teeth kicked in during a business pursuit. And that sucks so bad that they think it's not for them. So the answer to your question is anybody can do it, but it's like anybody can run a marathon, but most people bail. Or more specifically, if you are training for a marathon and got injured, most people would view that as a sign that you should stop. Mm-hmm. But like, I trained for a marathon. I had an injury during it. I did a freaking 3-hour session on an elliptical. All right. Because I didn't want to miss my marathon that I was training for. But like, when you get injured and you can't walk, in your mind, in business, metaphorically, sometimes you're like, clearly this is a sign that this isn't for me. And I get that. But once you're accustomed to realizing that it is in fact a sign that you're heading the right direction, anyone can raise money. Easier said than done, though, my friends. And this is from someone that got completely morbidly embarrassed on my first capital raise after telling my friends and family that I was going to be a real estate entrepreneur, texting this girl, Christy, that I'm trying to impress. Hey, I'm going to go into my first capital raise. She's texting me back. Hey, how'd it go? Not good. I raised $0. So this is not like me coming from a place where I'm up here and you're down there. I was exactly in that spot. That's the reason I know what the feeling is like.
Something to go back what you said is the beginning of this. And I was the guy. I was your case study.
I have many though. Many.
Totally. I mean, I know 3 or 4 guys that I met probably through you that came from nonprofits, but I think it's the value of this skill of raising capital that people underestimate. That, Walker, to your question of lifestyle, the idea that you have to know everything about real estate in order to become a real estate business owner or a vice president of capital for a $250 million private equity firm is actually false, right? Because what I've gotten really, really good at over the last 7 years is capital development, is marketing, is the skills that it takes to really build an audience, which ultimately translate to invested dollars. And in my opinion, I would say that's an easier skill because it takes a lot of work, but it's an alternative skill than maybe what the traditional real estate investor was 10 or 15 years ago. And I do think that opens up the pool for a lot of people in this world of digital marketing, digital age, to the world of private equity. 100%. And that's really exciting.
And there's a lot of tailwinds to the space, and it's just going to keep going. And, I'm excited to play whatever role I can in it. And I know you are as well.
So here's what I want to talk about today. And then, guys, we want to answer your questions if you're live. So drop your questions in the chat for these 2 guys, for all of us. Going into 25, and I talk to a lot of fund managers, okay, because we work with a lot and I'm friends with a lot. And a lot of these guys, including myself, have been building businesses for the last 2 or 3 years. But the thing that I hear most often and where they're trying to transition in 2025, and these guys have raised 40, 50, 60, 70, 80 million dollars of capital. You know what they don't have? Cash flow. Because a lot of the deals they've raised for were multifamily developments, or maybe just multifamily deals that are no longer paying me right now, which is the case for most multifamily deals. So they've built and had tremendous success, but don't have a lot to show for it at the moment. And maybe they will in 2 or 3 years, but they don't right now. So I want to just talk about, like, for both of you guys, when you're thinking about building this business or any business, or the advice you would give to someone early, just starting, or even a couple of years in, let's talk about cash flow for a minute. How important is that up front to be in this for a long time? And what advice would you give for someone new starting, but maybe, like I said, that case study of someone who's 2 or 3 years in, they've had success, but they don't have a lot to show for it yet?
Well, listen, man, it's crazy how things can turn around, right? It's crazy how liquidity can turn around. And, every business, ours included, of course, is going through this process where the velocity of money in the run up to 2019, 2020, 21, 22 was so high that the number one thing I was dealing with, and I mean, this is just me being honest, it was a great weight on my shoulders to try to offset gains. I mean, that was on my mind constantly, because how stupid am I going to look if I don't plug this money away into a deal before December 31st and I just get murked by multi-6 figures of taxes? How dumb, like, that's the most predictable and stupidest thing in the world. Obviously, you'd want to take the money in a bank account, move it to another bank account, and then save whatever, a big number on taxes every single year. And so the game was try to eviscerate your own liquidity to offset gains.
Yeah.
And certainly you're going to be okay, because if the velocity of money is even close to what it currently is, you're going to be fine in a a month. You wait a month and you're good for the year. Like, that was kind of situation that a lot of real estate entrepreneurs, capital raisers, they found themselves in that situation for years. And then all of a sudden it turns around and the game turns into, oh my gosh, how can we get any liquidity to shore up our balance sheet? And then it goes negative when, if you go through a capital call, for example, which we have, I've done quite a bit of deals, all different structures, risk profiles with other operators that have different perspectives on things. So if you go through a capital call, you probably have found that, sometimes those don't go as planned and you have to plug money into deals to save deals, which maybe you think that's appropriate or not, but either way, I have done that. And so then your liquidity can get really, really squeezed. That doesn't even get into the fact that when you do stuff like that, if you don't hit the promote, you don't get paid later. And so people are starting to realize now how this can all add up and what the real net implications are. And so from my perspective, here's a couple things. One, this still works. Real estate is the number one wealth creation vehicle in the country for sure. And don't let your emotions get in the way of forgetting that, or remembering, I should say, that this is a legit game. It's the best way to create wealth predictably. Number two, don't think like an LP investor. So you should be thinking like a business owner if you are a business owner. So what that means is that in the beginning of my capital raising career, the number one thing I wanted to do was, I had money in the stock market. I wanted to move it into passive investments. I wanted to help my mom get her money into passive investments. And so I would lead with the fact that, hey, listen, I'm probably going to be the biggest LP in this deal. And that's an easy button in terms of value alignment, incentive alignment. I got money to invest. And so you smash that button because it makes it easier to raise money. The problem, though, is that doubling your money in 5 years should never be your goal as a business owner. That's a reasonable and solid return as a dentist who's making all his money as a dentist. But if you're flying around the country looking at properties, taking pursuit cost risk, putting up earnest money deposits, managing and operating the deal, you're not trying to double your money in 5 years. In my business, if we have an employee, they should provide around a double in 1 year, right? If I have a $100,000 employee, my goal is that they should produce around $200,000 of profit, right? So that's how business owners think. So I would challenge everybody that's listening to this to dramatically shore up your liquidity, constantly be shoring up your liquidity so that you can make it through times like this. And then also when you go to create your business plan, don't do what I did, which was create a business that was so lean and mean, there was no margin for error. And I wasn't going to get paid until year 5 if the deals did well, which I did that because I wanted to do the right thing. And I was trying to be heavily incentivized to only do deals that would perform. And I wanted to distance myself from financial advisors that make money no matter how well deals do. The problem, though, is that when you don't have any money, you're not in a position to help anybody, including your investors. So I went on a little bit of a tangent there, but those are the couple things that comes to mind. Don't think like an LP investor, shore up your balance sheet. And most importantly, this game works, but you got to be able to play right now to make it fun on the back end.
Walker, give us your perspective as a guy who's owned and bought
Sure.
businesses.
Yeah, thanks. So I think that, look, it's one of these where, I'm known for acquisition entrepreneurship and buying small companies, right? And what I'm going to tell you is that it's very, very simple to look at financial statements and feel like you understand, the kind of cash flow that's going through the business. But there's a big gap between what it's like living in a business and operating living off the cash flow and keeping it going, and looking at financial statements and understanding, different periods of time and maybe cyclicalities that could be in there. Okay. There's non-cash cash expenses like principal payments, on loans, so on and so forth. Okay. So I think that, when it comes to working with people that are doing business acquisitions, the first thing that I would tell you is that most people aren't able to really understand the cash flow or lack of cash flow or cyclicality of cash flow in the business that they're considering acquiring. Okay. And the deal is that cash flow, like, I didn't make this up. Cash flow is the lifeblood of any business. Okay. And if you think about cash flow in terms of someone's life, okay, their personal area. Cash flow is the thing that creates financial independence, right? So on a personal level, it's the difference between financial independence and not. And on a business level, it's between the lifeblood or frankly going out of business. I mean, I could share stories about, buying a company and being in the Great Recession and having to, furlough employees, lay people off. It's terrible, right? So when cash flow is low, it's terrible. When cash flow is good, you're able to grow. And that's the thing. And so, when cash flow is good in your fund of funds model, you're able to go to Raise Fest, right? You're able to do more marketing. You're able to do all of these things. And so that's ultimately, what you're looking to do is have cash that you're able to move through the business in order to grow. That being said, when you start a business, Ellis, okay, I always, startups fail, right? And so buying a company is a part of the solution, okay, for entrepreneurs who are trying to own a company. That's kind of how I've always approached it. But the truth is every time I start a business, I always say like, all right, I'm not going to take any cash out of this. I'm probably going to put a lot of money into it for quite a while, right? When it comes to, look, I just started raising capital in 2023 last year, and what I would 2024, sorry. And what I would tell you is everything that, I'm gonna kind of harp on what Hunter said, which is, if you align yourself with the capital, it's amazing what things line up, right? Like, I was already getting all kinds of deal flow and all the rest of it. And then I spent about 7 months raising capital. We raised about $13 million, just over $13 million across 3 deals. I'm able to pick, the sort of things that I want to get involved in. And now, it's kind of really interesting to take this community of business, acquisition entrepreneurs and sort of say like, hey, let's also diversify and expand into the private capital markets. And like, surprise, I invest in real estate, and, surprise, here's the sort of businesses that I've been diversifying into, and let's go ahead and do these fractional acquisitions together. And then I'm able to negotiate, sort of my cash flow in the deal, not at the expense of the investor. And typically it's able to get the investor even a better deal, right? Like coming through the SPVs that I'm creating, rather than even going direct. And so I'm able to sort of go to them and say, look, I can, I've got this community, we can raise all of this capital. This is what I want to do. And ultimately what I'm trying to do, Ellis, is like, just work with awesome people on great projects and stack cash together. And that at the end of the day is the goal. And once you align yourself with the capital, and once you align yourself with the cash flow, that's when all the projects and all of the other things kind of line up in place, right?
Yeah, I mean, from my perspective, I look about the first 5 years of my career and then joining Aspen over the last year, and the ability that we have to spend and market and do creative things, because what Aspen did for the first 10 years of their business model is they did one thing, which was a private debt fund. And if you look at, it's incredibly brilliant. They did one thing, they got really good at it, and it's been paying investors 9% every month for a decade. And they've taken so maybe they make the net of a 12 or 13% fund, right? So they've built this massive cash flow machine for their investors, number one, which has built, 10 years of trust, right? And then not only that, they've built millions of dollars of cash flow because they've grown that over 10 years, right? And now we're launching over the last 3 or 4 years into alternative assets and being able to grow to $1 billion private equity firm. And I'm like, I wish someone would have told me that, right, 5 years ago when I first started, because I think it's such a brilliant model. And when you have the cash flow and you even focus on doing deals that create consistent annual income for you, and there are things out there like that. Our private credit is like, we have a fund for private credit. That's one of them, right? And that's, again, that for us at Aspen, that's, debt was the last 10 years. And I guess private credit is still debt, but mortgage note investing was the first 10 years. Commercial real estate debt, private credit, in my opinion, will be the next 5 to 7, 10 years of Aspen, that creates that same money-making machine, right, for our investors and for the company. And it allows us to go do things like oil and gas, which don't necessarily pay us up front, but the upside 5, 6, 7 years later, oil and gas fund is massive. And so I think it's a huge point I want to make to anyone who asks me about what should I know in getting started. It's like, man, prioritize what Walker just said, the lifeblood, right? Make sure you have the margin, the ability. And to Hunter's point, it doesn't take long. Like if you just, 1 or 2 years and you've built 2 years of trust of paying an investor every single month, then to compound that into upside opportunities is so huge. And I think that's another mistake that I can point to early in my career is our first 3 or 4 deals were 5-year plays. So meaning no one saw anything for the first 2 years. Well, I'm still running and trying to operate a business in those 2 years and grow my lead flow and get reinvestments. The likelihood of someone wanting to reinvest, do you think it's higher or lower if they haven't received a distribution in 2 years?
Lower.
Right? It's lower, of course. Yeah. And so if you start with something that is paying you and paying them, that compound effect and the trust you build, I didn't do this. I just look at Aspen. I'm like, that's what built this house.
Ellis, sure. Did you always have a mustache, or did you decide after you joined Aspen that you needed to look like Tom Selleck?
No, I lived in Spain for 6 months. When I came back, I actually had a pencil.
It's the cash flow stash.
I had a pencil stash and what's the hat called? The little
sombrero. That's down south. I don't know. Yeah.
European. The European hat. Fedora.
I have to look it up.
Okay, cash flow. But let's go above that. We got a little bit more time together.
I mean, like if cash flow is one of these like significant, kind of pivotal things that kind of engineered success for Aspen, let's say, right? Like, Hunter, what were the sort of moments that the decisions that you've had to make, along either your fundraising journey or even with Raise Masters and Raise Fest, like what were the decisions that you had to make in order to like scale your ability? And I'm kind of listening for like, how important is personal brand, or like were there moments where, you were sort of like sitting in a dark room with your head in your hands, having to make these tough decisions that ultimately ended on, your success in scaling your businesses?
Yeah. I mean, there's been many. One, I'll say is that in the wake of the Great Recession, when my career was really born, I thought diversification was the ultimate true north for protection. And it's an important tool in an investor's pocket. But if you use that as a true north, it lends you away from other things that are really important in business as well. And so as an investor, diversification might be important, but it lends you away from things like control. It lends you away from things like economies of scale, repeatable systems and processes, relationships that can be used over and over again. Those are things that are also really important in business. And so I think at the beginning of my career, I over-optimized for diversification and probably had a bit of the shiny object syndrome. And part of that was my own personal interest, but also part of it was just equity. People were starting to be interested in getting out of the spectrum of normal traditional investments and wanted things that were more interesting. And, I'm obviously a business owner raising money. So I looked at some asset classes that were not traditional. Some of those perform very well. Some of them perform very poorly. And, there's just a big spectrum of what's out there. In the world of investing, there's everything from people that are incredible, that intimidate you, to gonna go to jail. That's pretty much the spectrum. And I've done enough deals to where I've seen all of that. And there was a point where what I wanted to grow became way bigger than what I thought I could grow. I'll put that another way. It became clear that I could grow something bigger than I originally thought. And once that started to happen, that deferral to a third party to execute a business plan became a massive impediment to our growth and success. And so it's typical. If you get into the world of capital placement, eventually you recognize that the person that you're making promises to your investors that someone else is going to deliver on. And at a certain point, if you grow your company, if you grow your brand, if you grow your investor pool, that is a massive, massive risk you're taking to that third party. Now, some people can do this through doing way less partnerships or only partnering with people they're essentially in business with and in a equal footing. But for us, we basically decided what we've grown at this point is so large, we can't risk that reputation on a third party. And so we decided to go all in and basically completely inverted the view of diversification, going from hyper diversified with a specialist in finding great diversified opportunities to now we're only looking at deals in a 40-mile radius. That's one.
Mhm.
Another one is I have absolutely, just intuitively, you got to know yourself. And so for some people will say, I want to go right when other people are looking left. Some people have problems buying at the bottom. Some people have problems selling at the top. For me, I have absolutely no problem going all in when others are retreating. I probably have a problem wanting to sell earlier than is probably the best, the most optimal, because once the exuberance starts to hit, I'm freaked out a little bit. But to prove this, there's also a downside to that, right? Like we grew a business in a real estate market that was essentially collapsing in deal volume, which is critical to liquidity. We have a coaching business, which is historically extremely volatile. We exploded the business, both in terms of clients and spend and everything, at a moment when deal volume went dramatically down. So while we have some competitors in the space now, we basically had none when we started. But the competitors that came up, they basically have, collapsed or completely, they're no longer existing. We did not experience a result like that, but we definitely scaled and was like, I said, screw the market, screw everyone else, screw our competitors. We're going to double the size of our company during that. And that takes a massive toll on balance sheet, profitability, cash flow, maybe mindset. And that's a toll that I paid. And, we're still good and rocking out, but like, that's a lesson I had to learn as a business owner is like, there's a book called Profit First. And my wife has been telling me, read this book first, read this book first. I'm like, that's like your way of doing business. My way of doing business is middle finger to everyone that says I can't do it during this time. And that's what got me here. So how can you say it's not true? But it's a good idea to know where your profit's coming from as well. And so this is a balancing act, but like more than anything, no matter what mistake you make as a business owner, you just got to keep going and using your best intuition about the information that you have, because knowing that all the decisions you make are probabilistic in nature, they're not cause and effect like we're kind of wired to think they are. And so the more that you can realize that as long as you're making the best decisions with the information you have, you will eventually win if you keep going, because most people don't. Most people bail. So when I was mentored by people that I looked up to that were like, diversification is key, the fact that I used their word and went for that is not a mistake. That's just the best that I could do at the time. And so if you've been through some challenges, if you've gone through some deals that have had problems, just know that like what makes you good is not having the best intuition. It's that you learn from your mistakes and you keep moving. In fact, whoever does it faster wins.
Was Fund of Funds model sort of a stair step capital raising platform for you? Like, and it sounds like you ultimately moved into like sponsoring your own deals and having your own sort of, GP.
That was my route, but it also can be used in a different route. So like that was my route because there was a lot of reasons for this. One of that, I really liked the capital placement side of things. Also, I was really focused on diversification. So that lends itself to that. And so you can see how, like if you have a W-2 job, for example, a fund of funds is a great way to hybrid your way either into going full-time into real estate or just constantly having a good side hustle and making money while you do your W-2 as well, which I think is a really good strategy. However, given that deal flow has changed dramatically in the last 3 to 4 years, I've seen a lot of very large sponsors effectively implement the fund of funds strategy as well, where they're partnering with other operators and other asset classes or other geographic locations to continue to provide their investors with deal flow. So don't think of it as like a junior strategy that only beginners implement. I mean, the fund of funds vehicle is something that people do at the highest of levels.
Yeah, it makes sense, right? Because I'll give 2 examples, both what we've done, but what I've seen. And what I've seen externally is you've already built the trust. You've already built the trust. And be it you have one asset class. Okay, so the investors trust you, but they can only invest with you in oil and gas because that's all you do.
Yeah.
So as soon as you open up another opportunity, the hardest part is building the trust. The easiest part is finding another opportunity, right? So you're exactly right. We've seen sponsors in that. Same way with us. We have, let's say take our private credit fund, which is slowly growing. We raise a few million a month. Well, we had a distressed mortgage note opportunity that we opened up, and I just joined, and I come in and we're grueling out $5 million a quarter. We open up this growth fund. We committed $15 million overnight. Literally, we did a webinar. The next day, we had $15 million. It was just like, because we already had the trust.
For sure.
And it was a different opportunity. And so to your point of just like the fund to fund model is an incredible thing for experienced sponsors too. And I'm glad you bring that up because I don't think that's been talked about much either, about how to maybe profit in 2025 as a real estate. If you're looking to how do I grow cash flow? Well, maybe introduce something like a debt fund or private credit or something like that.
100%. 100%. And it's a matter of what their model is. Like for us, we're not interested in entertaining that, even though deal volume has dropped dramatically. But for other groups, that is totally part of their wheelhouse. And I love seeing what Aspen is doing in a bunch of different verticals. But it isn't that they're hyper focused on diversification. They've got a couple different key opportunities with a couple key partnerships that they're willing to bet their career on. That's the modality. That's the lens through which you should view that conversation. What you don't want to do is be focused on what the deal profile is, because you and I both know that's almost irrelevant when it comes to protecting investor capital. It's all about what the principles integrity is, and not just their integrity, their balance sheet, their ability to solve problems when things go wrong financially, right? Because some people have really high integrity. They don't have any money. Something goes wrong. They'd love to do something about it if they could, but they can't. These are things that are really important when you're thinking about partnering with a fund of funds partner.
So good. We got a little more time here before we run up. Hunter, here's what I want to. Let's do some like rapid questions, Walker.
Let's go.
Okay.
I'll be short worded this time. Let's go.
Okay, so here's my number one question. You're leading. I mean, you've taught. You're seeing hundreds of capital raisers. What's the top 3 lead flow strategies? Right. What's working best in terms of lead flow, top of funnel for accredited investors?
I mean, one of them, I don't talk about this a lot, but honestly, one of them, you got to have some sort of velocity of deal flow. I'm just saying this because we just talked about it, but it's, if you're not doing anything and not putting anything in front of your investors, it's really hard to keep the show going. So that's one thing I'll say. As far as true lead forms and such like that, I mean, number one, before I even get into this, if you've heard me or other people talk about the fact that you need a lead magnet, and it's been like 9 months if you listen to people talk about this and you haven't done it yet, like, does it even matter what I say? Because like, I'm just being real. Like, it's so easy right now. Go to ChatGPT, say 7 things that, 7 things dentists need to know about investing in real estate. It'll provide 7 things, then comment, make it more specific to dentists. It'll be 7 more things specific to dentists. Those are your 7 chapters of your ebook. You write an intro, you write the 7 chapters, about 500 words per chapter. Chapters like, the first reason, second reason, et cetera. And then an outro and a prompt to book a call. That is your first lead magnet. So number 1, go ahead and do that. It's an ebook. It's easy to do. Number 2, I have found that lead magnets that compress time to value are really important right now. So what I mean by that is that people's attention span is very short, but also when you go out to the marketplace and you don't already have reputation, credibility, track record, buy-in, if you write an ebook that takes an hour to read, no one is going to read the hour-long ebook and you're not going to give them any value. So they're coming in hyper skeptical of you. So instead, you should try to front load the value as much as possible, even if it doesn't take any time to actually consume. And I'll give you an example. One of the things we've had a ton of success with is just due diligence checklist. Here's 100 things you need to ask before you do your next deal or invest as an LP. The moment they look at it, they'll see something they're not currently asking. And as long as they look at it, they're going to get some value from it. Another one would be like an Excel underwriting model, right? Even if they don't use the model, the fact they see it, they see that it's more detail oriented and dense than the one they're currently using, or they don't even have one. They just know this is a credible group that knows what they're talking about. Another example is something that I'm working with our clients a lot on right now is what we call VSLs, video sales letters. So people are used to doing these like 90-minute webinars that it's a tough ask in today's climate. We are using micro webinars to both pitch deals and book calls. So these are like 7 to 13-minute videos that basically go through the highlights of the deal, both in terms of the story, but also in terms of the return profile. And that is enough to get them to opt in to later perhaps book a call with you or even watch a longer webinar. But keep in mind, I am not obsessed with you. And most of your investors are not obsessed with you, especially if they don't know you. You are thinking everyone's going to like, and this is because I'm thinking of this for myself as well. If I used to work so hard on like a lead magnet and I send it out and no one would take it seriously. And it's like, dude, the open rates of emails is like 18% on average. The open rate, only 18% are even getting opened. Oh my gosh, I just realized I said I was going to be short-winded. I'm so sorry. I can't even do it.
It was a long question, Hunter. It was what are the 3 things that transform the world?
Yeah, that's fine. Well, I'll keep it there. I literally can't believe that because I literally forgot it was fire round, but I won't do it on the next one. This time I promise.
There was some gold in there. There was some gold in there for sure. Walker, you had a question?
What's your morning routine? What do? You look like Superman under that polo shirt. I can see you're like ripping out of it. What do you do? What's your story?
My man. So I'm not the morning routine guy. I used to be very much into that. And I don't know, I kind of fell off it some way. And I haven't really had that inclination to get back on. I think it's because I do my best.
That typically
it happened before that. He's calling me out, but it did happen before that. My morning routine is to get to work as fast as possible. Honestly. Yep. So I wake up, I have about 20 minutes with my kid as my wife gets ready. And then I try to get to work as fast as possible. And that is my morning routine. And I think it's because I do my best work there. So that extra like 10 to 20 minutes of morning routine that I used to have, it's better served working. Later, I usually work around 6:30 a.m. to around 3 to 4 p.m. And then I have a little bit of protein, a little bit of carbs, gym. Right now I'm training for something called Hyrox, Hyrox. Check it out. It's pretty cool. And typical stuff, trying to be jacked, trying to be strong, trying to be fast, vibe. That's perfect. The vibe.
Go on Instagram. You can see he's serious about deadlifting. He can move some weight for a skinny guy.
My one lift. It's true.
What else? Guys, I want to just recap this time together. If you want to come hang out with us, I have no problem re-promoting 100's up to at raisefest.com just because I think it will add a ton of value. We're going as a sponsor, both because I think there's a lot for us to learn. Clearly, there's other people doing this at a high level. And 2, it's an incredible networking opportunity. I know we'll meet people that will be interested in partnering with us. And so I would say, regardless of where you're at, come because it will bring value to you and your business. If you are an experienced fund manager or capital raiser, or as we talked about today, a sponsor looking for other deals, go to aspenfunds.us/fund manager and apply to work with us in 25. And let's have a conversation about that. Guys, what else before we go? Walker, Hunter, closing comments.
I mean, yeah, raisefest.com. I'm super honored that you gave me a shout out like that. Obviously, like, does mean a lot to me. And look, if you go to the website, you're going to see a trailer that's not like a typical private equity event. It's not. Like, you can listen to all the content online anywhere for free. If you're going to go to an event, we take it very seriously. We want you to have a transformational experience. And so we'll give you the tactics. We'll give you strategies, email templates, copy and paste. We'll give you all that. But more than anything, I mean, sometimes you just got to have that unlock moment where you realize you can do it at the higher level. And that's true of me. And that's true of everyone that wants to do great things. And so that's what RaiseFest is really about. Don't get caught up in the mindset stuff. That's not what it is. It's more like, what's the unlock? What's the freaking unlock? And that's what I want to give people.
Walker, do you regret going live with me?
No, man, this is the best day of my life. Hunter, it's great to meet you. I've admired you from afar for a while. I think it was a long time coming. I've been raising capital myself only this last year, and decided that I needed to, learn from the best in the space, which is how I got to know Ellis. And now I'm coming to Raise Fest next month. Looking forward to hanging out with you further.
Super mutual.
Yeah.
Thanks again for the opportunity, guys.
Hey, hit subscribe or follow me wherever you're doing this. We're going to keep doing live streams like this, and I'll see if I can get Walker and Hunter back on here in the future. So thanks, everybody. Peace.
Thanks, Ellis. Thanks, Hunter.